Okay, good afternoon, good evening, good morning, as whichever time zone you are. Good evening, everyone. Can you hear me and can you see me? And do you remember me? Yes. Good evening, everyone, once again. So, how are we all? Are we all good? Real good, guys. Yes, message me here. Message me here. In CA Jagbandu, yes. Not in that other person. Yes. 1 second, let me just rename it, so that there's no confusion at all. This is me. Okay, now it's only me, CA Jagbandu. Okay.
Yes, sir, that solution is it uploaded, sir?
Yeah, I will do it. Don't worry. Don't worry.
Okay. Thank you.
Don't worry. I said I'll do it, so I'll do it. By Monday, you'll definitely see on the board.
Okay, sir.
Okay. Yeah. So, how are we all? All good? Everyone? At the end, can I ask out, sir? Yes. You can ask. Let me just complete the agenda for today, and then probably the ending part we can take the question and answers.
Sir?
Yes, Vaidehi?
Sir, I just have a doubt in the derivation of the formula. Because in operating leverage, sir?
In the derivation of?
The ratios.
Ratio?
There is the operating leverage formula. Right?
We'll take it that later. Let me first complete this leverages part, okay?
Okay, sir.
Okay, so we have been like up to question number 8. Now, let me take up the next question for our discussion. 2 concepts are pending in this. One is regarding the application of preference shares. Okay. And second is with regards to the break-even point. Okay. So we have such a question in our handout also. Yeah, there is something called as margin of safety and break-even part. We'll take that. Right now, let's go for discussing the concept of preference shares and preference dividend on the leverages calculation. So for that, let's take up this question number 4, guys. Okay, question number 4. Question number 4, guys. Yep. So in question 4, the operating income of textile firms amounts to 1,86,000. So we have this EBIT of 1,86,000. From that, we are going to subtract the interest. What will be the amount of interest? The interest will be 14% debenture. So 14% of 5 lakh, right? So that's 5 lakh multiplied by 14%. And then we have the profit before tax as 1,16,000. Then less taxation, right? So taxation is given to be 50%, right? So this multiplied by 0.5, 50%. Then we get a profit after tax. But our income statement is not going to stop over here because we have preference dividend. So I need to further subtract the preference dividend. What will be the amount of preference dividend? Preference dividend will be 1 lakh into 15%, which is 15,000. And then we have finally net profit for equity shareholders. And this is our net profit for equity shareholders. We have to determine the firm's EPS, which is pretty easy because that's like number of equity shares. So we need to divide this by number of equity shares. Number of equity shares will be like what is the number of equity shares? 4 lakh is the amount and 100 rupees the face value. So 4,000 number of equity shares. And then we get the EPS as 43,000 divided by 4,000 is 10.7. So we got the firm's EPS. That's pretty simple. Now the second part, determine the percentage change in EPS associated with 30% change, both increase and decrease in EBIT. So if EBIT increase by 30% and EBIT decrease by 30%. EBIT decrease by 30%. So what will be the value of EBIT? Can you complete this statement and calculate it to EPS, guys? Can you do that? Yes, sure. Calculate the EPS, guys. Calculate the EPS for both the things when the EBIT increases by 30% or when it decreases by 30%. Okay, so time up. I hope you have got the EPS, everyone. 17.725 and 3.775. Right, so it was pretty easy. So determine the percentage change in EPS. So they're asking for percentage change in EPS. So percentage change in EPS. So in this case, percentage change in EPS is 17.725 minus 10.75 divided by 10.75. Right? So what is the percentage change in EPS? Can I say for 30% change, the EPS is changing by, I mean, if EPS is increasing by 30%, then change in EPS 64.88. Same way, the decrease in EPS will be this minus the value divided by the older value. So the EPS is changing by minus 64.88%, right? Did we get this percentage changes also, everyone? 64.88%. Yep. Great. So percentage change in EPS stands as 64.88%. Right? So 64.88, which is the new value minus old value upon old value. So now, when there is a 30% change in EBIT, we see that EPS is changing by 64.88. Okay. Determine the degree of financial leverage. Now, degree of financial leverage. Financial leverage. Original formula is percentage change in EPS upon percentage change in EBIT. Right? So if I apply the original formula, percentage change in EPS is 64.88 for a 30% change in EBIT. So this will be like 64.88 divided by 30, which is 2.16 times. Right? But just try to apply the shortcut formula like EBIT upon PBT. Just check whether this is working or not. So this is like EBIT is original EBIT is 1,86,000, right? And then we divide it by PBT, which is 1,16,000. So if you try to solve this, what is the answer? Is it matching? The shortcut and original formula, are they giving conflicting answers? Yes, they're giving conflicting answers. Now, which one of these two do you think is accurate? Is 2.16 accurate or 1.60 accurate? Of course, 2.16 is accurate. So the idea is, I'm talking of whenever there is a percentage change in EBIT given to us and we're looking at percentage change in EPS, remember that this is not working, like EBIT upon PBT. So shortcut is actually not working. EBIT upon PBT, the shortcut thing is not working. Okay, so as the shortcut is not working, how do we go about modifying this formula? Well, the shortcut formula is there, but there is a bit of modification. Instead of doing EBIT upon PBT, okay, instead of doing this EBIT upon PBT, it will be PBT minus preference dividend upon 1 minus T. This is going to be like 1,16,000 minus preference dividend is 15,000. 15,000 divided by 1 minus 0.5. Right? So this becomes like, it's calculation wise. Numerator is 1,86,000, but the denominator will be 1,16,000 minus 30,000. This is 1,86,000 divided by 1,16,000 minus 30,000. So this is 2.16. Now this is what is exactly matching with our answer. So whenever we have preference dividend, financial leverage, formula will be revised. it won't be EBIT upon PBT minus preference dividend upon 1 minus T, but rather it will be PBT minus, it won't be EBIT upon preference dividend, EBIT minus PBT. We need to add the, we need to take into account the preference dividend payment also, because that is also your finance expense, right? So preference dividend is also your finance expense, and therefore that needs to be subtracted from PBT to arrive at the denominator, and then we have this number of 2.16. Is this clear, everyone? Tax 1 minus T is only on the PBT part. Or to write it, I'll just write it for clarifying the things. Financial leverage will be EBIT upon profit before tax minus preference dividend upon 1 minus T. EBIT upon profit before tax minus preference dividend upon 1 minus T. Correct? Is this clear? Operating leverage will have no effect because operating leverage is anyways not connected with EPS. Right? Operating leverage is anyways not connected with EPS. That is just contribution upon EBIT. That will still continue. But yes, when you look at the combined leverage which was contribution upon PBT, right? Now it won't be contribution upon PBT, it will be contribution upon PBT minus preference dividend upon 1 minus T. Okay, is this clear? Guys, okay. So when we have preference dividend, this additional component needs to be taken into account. That is minus PD upon 1 minus T to calculate the financial leverage. Okay. Then what additional data do you need to compute the operating as well as combined leverage? What additional data do we need? We need the amount of course, contribution. Because once we get the contribution, then we can compute the operating leverage. Okay. Everyone? Fine. So that completes this question number 4. Now let's do one more question. It was something really interesting. Okay, let's do this question 13 and then post that we'll discuss about the other thing, which is about the financial, about the combined leverage is not done. Question leverage, question has asked for combined leverage also. No. The question says, what additional data do you need to compute the combined leverage or the operating leverage? So additional data is, we will need the value of contribution. So unless we get the value of contribution, we won't be able to calculate. That's it. We can't calculate, in fact, operating and combined here because we don't have information about the contribution. Okay. Fine. So then let's go for after 4. Let's go for this question 13. Speak loudly, very slow voice. Is it? Is the voice slow? It's clear, right? It's clear. I think, Bhavna, I should check your volume level in your device. Okay, question 13. Alpha Limited has provided the following information. Equity share capital is given 25,000. So equity share capital is 25,000 shares. 25,000 shares of rupees 100 each. So this is like 25 lakh. Debentures are given. Or tell me, if you would you like to solve it on your own, this question? Yes. like to try? Okay, go ahead. Try to solve it, but again, I'll give you some time limit for this. Okay. Try to solve this. Try to solve this, guys. Okay, let's start with the solution. Okay, so 25 lakh is the equity share capital. Debenture is 10,000 debentures at rupees 750 per debenture. So this should be like 10,000 into 750, right? Then we have sales, variable cost, and fixed cost. Okay, so total capital employed is 1 crore. Let me prepare the income statement. We start with EBIT. So EBIT is, as they given the EBIT, no, sales have been given. Okay, so we have to start with sales less variable cost. Then we get the contribution. Right. From that, we reduce the fixed cost. Okay. Then we get EBIT. Okay. EBIT. From that, we reduce the interest. So we get the PBT. And do we have the tax rate given? Yes. So less tax will give us PAT. Then we take down the number of equity shares and calculate the EPS. Okay. So originally the sales is 50 lakh units at rupees 20 each. 50 lakh into rupees 20 each, which is 1 crore sales. From that, variable cost will be subtracted at 12.5 per unit. So that's 12.5 into 50 lakhs. 12.5 into 50 lakh. Contribution will be sales minus variable cost. Then fixed cost is 175 lakhs. EBIT is contribution minus the fixed cost. Right, and the interest is 15%. So interest is going to be 15% into the debenture. Right, so we get the profit before tax. This number. Then tax rate is 20%. So this multiplied by 20%, and then PAT will be the difference between them. Number of equity shares. Number of equity shares is 25,000. So EPS is original EPS 604. Everyone, original EPS 604. Now, if your sales is going to decrease by 15% or 20%, so let us say this into 0.85 or this into 0.2. Okay, then we have this numbers of the interest will continue to remain same. So, of course, this will be like 12.5, this into 0.5, which is a change of 15%. Right. And into 0.8. So check if you're getting the EPS as 424 and 364. Yes, 424 and 364. Perfect. So required to calculate the decrease in earnings per share, degree of operating leverage and financial leverage separately. If sales are declined by 15% and 20%. So you have to compute the degree of operating and financial leverage. So what will be degree of operating leverage? Operating leverage, you can simply say contribution upon EBIT, and degree of financial leverage is simply EBIT upon PBT. Right, guys? Degree of operating leverage and financial leverage. Did we get it? Yes. That's pretty simple. That is done. That's it. There's no more thing to discuss about this question. Pretty simple question. Right, guys? Okay. Then let's understand the next concept, which is break-even point and margin of safety. Are we aware about these two terms? I think you might have learned this in cost accounting subject. Have you learned this cost accounting subject? Break-even point and margin of safety? No? Okay, then I'll put some time for you to make you understand what is this break-even point. Do you remember something called as financial break-even point from our capital structure chapter? What was that financial break-even point? Financial break-even point was, the level of financial break-even point was the level of EBIT at which your EPS is 0. So here, break-even point, when we generally say, what do we mean by break-even point? We say break-even point is that level, or this is the level of sales at which EBIT is equal to 0. So break-even point is the level of sales at which the EBIT is going to be equal to 0. Okay, so we're looking for that level of sales at which we should be having our EBIT to be equal to 0. So for example, let's say we have got the variable cost. We get contribution. From that we reduce the fixed costs. Then we get the EBIT level. So suppose I tell you, I'll give you some information that fixed cost is 2 lakh. Okay, fixed cost is 2 lakh, and the PV ratio. PV ratio is basically contribution upon sales figure. Okay, so let's say contribution upon sales is suppose 40%. Right? So if suppose sales is 100, then variable cost is 60 and contribution is 40%. Right? With this information, can you tell me what should be the level of sales so that my EBIT is 0? What should be the level of sales at which my EBIT should be 0? Yes, guys. So if your fixed cost is 2 lakh and your PV ratio is 40%, what should be the level of sales at which our EBIT should be 0? Yeah, guys. I can get some answers, but let me, simply derive this. Let's take the sale as X. So if we take the value of sale as X, what will be the value of variable cost? What will be the value of variable cost? Can I say, since your PV ratio, contribution is like 40%. So if your sales is, 100, your variable cost is 60, and therefore contribution is 40. Right? Because our PV ratio is stated to be 40. So now, what will be the variable cost? What will be the variable cost? Variable cost will be, can I say 0.6x, and contribution will be 0.4x. Right, guys? So if your sales is X, variable cost is 0.6x, contribution is 0.4x. So what will be the EBIT level? Can I say EBIT will be 0.4x minus 2 lakh? since we want the EBIT to be equal to 0, since you want EBIT to be equal to 0, can I say 0.4x minus 2 lakh is 0. So what will be 0.4x equal to? 0.4x equal to 2 lakh. So the level of sales at which this is going to be 0, can I say it is 5 lakh? Got it? Value of x is 5 lakh here. So if you take the sales as 5 lakh and then try to compute the EBIT, it is coming out to be 0. So this 5 lakh is the break-even point. Break-even point is 5 lakh. This 5 lakh, I can simply put up a formula for break-even point. I can simply say that the formula for break-even point is, how did we get this 5 lakh? It was 2 lakh upon 0.4, right? So x was computed as 2 lakh divided by 0.4, right? So this 2 lakh upon 0.4, can I write this as, break-even point, I can write it as, what was this 2 lakh? So 2 lakh was the fixed cost upon 0.4. What was the 0.4? PV ratio, right? So a simple formula to calculate the break-even point is fixed cost upon PVR, right? Correct, guys? Yes or no? Right. So suppose sales, if you take it as 5 lakh, sales if you take it as 5 lakh, then the variable cost will be 5 lakh multiplied by 0.6. Our contribution will be 2 lakh, fixed cost will be 2 lakh, and EBIT is definitely going to be 2 lakh minus 2 lakh, which is 0. So at break-even point, we observe that at a break-even point, when we say the sales is 5 lakh, then EBIT is working out to be 0, guys. Now the point is, what if your sales is above the break-even point? What will be the result? What will be the result, guys, if the sales is above break-even point? Yeah? What will be the outcome? So what do you think? If let's say I have a sales as 6 lakh. I have the sales as 6 lakh. Then what is going to be the result of the EBIT? Will the EBIT be 0? Will the EBIT be 0? Yep, tell me. Will the EBIT be 0? No, right? So EBIT will, can I say, to become positive? So if you just try to compute this, what will be the result? It is, EBIT is coming out to be 40,000, which is the EBIT number. Now, what would be the situation if your sales is below 5 lakh? What would be the situation if the sales is below 5 lakhs? Yeah, guys. So EBIT, can I say it's going to be negative? If your sales is below 5 lakhs, EBIT will be negative, right? So let's say if I take this as 4 lakh and try to calculate this, then I say that there is a EBIT which is negative. So I'm not talking about this negative part as of now. Let's ignore that. So can I say when your sales is above 5 lakh, the company is in a safe zone? When the sales is above 5 lakh, the company is in a safe zone because it is making profits. It's making operating profits. If the EBIT is if the sales is above 5 lakh, then we say that the company is making sufficient profits, or the company is having the operating profits, right? So this particular 6 lakh sales is obviously a number which is above the sales. So if I ask you, what is margin of safety? What is the margin of safety? How do we compute the margin of safety? Margin of safety is basically sales which is above the break-even point. Margin of safety is the sales which is above the break-even point. Okay, guys. So margin of safety is sales minus break-even point. So margin of safety is simply sales minus break-even point. Now, if I want this margin of safety to be in percentage, margin of safety is to be in percentage, like how much percentage we are above the sales, above the break-even point, then we say it is sales minus break-even point upon sales. We want to know sales minus break-even point upon sales. So we want to know what is the margin of safety. So that will be simply sales minus break-even point upon sales. Or I can say out of this 6 lakh, if I want to compute a margin of safety over here, of course the margin of safety is 6 lakh minus 5 lakh, which is 1 lakh. But if I want it in terms of percentage, that will be simply 1 lakh divided by 6 lakh. Or I can say 16.67% of the sales value is the sales which is above the break-even point. So that is the excess sales that we have over and above the break-even sales, which obviously makes us think it in a positive way. So margin of safety as a percentage will be computed as sales minus break-even point upon sales. I hope this formula is clear, because we'll be using this formula for some other derivation now. Is this formula clear? Yeah. Okay. Now let me do some derivation for you. Let's say margin of safety. Margin of safety, it is sales minus break-even point upon sales. Now let me do one thing. I will simply multiply the numerator by PV ratio and also multiply the denominator by PV ratio. So I am multiplying both numerator and denominator by PV ratio. So I can just open it. This will be sales into PV ratio minus break-even point into PV ratio upon this will be sales multiplied by PV ratio. So sales into PV ratio minus break-even point into PV ratio, and this is divided by sales into PV ratio. We just opened up the bracket. Okay. So this particular thing was, of course, within the brackets. Okay. So sales into PV ratio minus break-even point into PV ratio, that was simply opened up. And now I can actually say that what is sales multiplied by PV ratio, guys? What is sales multiplied by PV ratio? Can I say PV ratio was contribution upon sales? The profit volume ratio was contribution upon sales, right? Or price volume ratio, contribution upon sales. So if I multiply, if I just multiply the sales with PV ratio, sales with PV ratio, can I say it's going to become contribution? So this particular portion is going to be contribution, right? So this is contribution minus break-even point into PV ratio, and this is divided by, again, sales into PV ratio will give us contribution. So contribution minus break-even point into PV ratio. Now, what is this break-even point into PV ratio? Because we just saw how do we get the break-even point. Break-even point was fixed cost into PV ratio. So can I say break-even point into PV ratio will be equal to fixed cost. Break-even point into PV ratio will be equal to fixed cost. So here this term, which is break-even point into the PV ratio, what is this number going to be? Contribution minus break-even point into PV ratio, which will be fixed cost upon contribution. Right? So contribution minus fixed cost upon contribution. So this is going to be simply contribution minus fixed cost upon contribution. Now, what is contribution minus fixed cost? What is contribution minus fixed cost? EBIT, right? So EBIT upon contribution. Okay. And here we had like margin of safety is EBIT upon contribution. Margin of safety is EBIT upon contribution. So if I do the reciprocal of both, reciprocal on both sides, this will be 1 divided by margin of safety, right guys? 1 divided by margin of safety is equal to, can I say, it will be contribution upon EBIT. 1 divided by margin of safety is contribution upon EBIT, correct guys? Okay. What is contribution upon EBIT, guys? Tell me what is contribution upon EBIT? Operating leverage. So can I say operating leverage is simply 1 upon margin of safety? Such a simple formula. Operating leverage is 1 upon margin of safety. I have taken all the efforts best possible to explain you the logic for this formula. Not logic, but I can say mathematic. Because logic works in a very simple sense. Mathematic works where your logic ends. Right? So, operating leverage, it's going to be 1 upon margin of safety. So I'm just not giving you the formula as it is. I'm just trying to, put a mathematic behind it. Okay. So that is what I wanted to look at right now. Operating leverage is 1 upon margin of safety. Now let us go for further discussion of, let's do a couple of more questions on leverage. Okay. So we have this question number 12 over here, guys. So let's do this question number 12. From the following information, prepare income statement of company A and B. Okay. Would you like to solve it? Question 12, guys. Then I'll take it up. Now you have the formula. You just need to remember one formula, that margin of safety is 1 upon operating leverage, or to put it other way around, operating leverage is 1 upon margin of safety. Would you like to try it, guys? Question 12. Yes? Great. Try to solve it. Yeah. Try to solve this. Question number 12. Yes, Hardik, you can.
Sir,
Hmm.
sir, one small doubt. Sir, if we have to calculate EPS is equal to 0 in this question, then sir, we have to go to financial break-even.
Where here EPS is not computed, right?
No, sir, in our example.
No. Then you'll have to look at it from a different perspective. You'll have to, like, if you want to look at EPS to be 0, then you need to get the EBIT value. So there you will get the financial break-even point. Yes.
Okay, sir. Thank you, sir.
Okay, so time is up. Let me get started with this. There's a margin of safety given, interest is given, PV ratio is given. Let me simply prepare the income statement. What the question is asking us, prepare the income statement. Okay, so income statement means then we need to look at like start with sales less variable cost will give us the contribution less the fixed cost will give us the EBIT, and then of course since a financial leverage is given, I need to also subtract the interest, so that will give us PBT. Is the tax rate given? Yes. Less tax, that will be our PAT. So with the information, interest is 3,000 and 2,000. So here interest is 3,000 and this is 2,000. Then we have margin of safety, financial leverage is given. Okay. First, let's start using the financial leverage. Okay, financial leverage, we know it is computed as EBIT upon PBT. So what is the financial leverage? Financial leverage is 4. So 4 is equal to EBIT upon EBIT minus the interest. So this is like 4 is equal to EBIT is something which is not known, but yes, EBIT minus interest of 3,000. So it will be 4 EBIT minus 12,000 is equal to EBIT. 4 EBIT minus 12,000 is equal to EBIT. So we get this as like 3 EBIT is equal to 12,000. So what will be the EBIT number? 4,000, right? So we got this EBIT as 4,000. Then PBT will be of course 4,000 minus 3,000. Tax rate is 45%. So this multiplied by 45%, and then PAT will be PBT minus tax, which is 550. Now same way I can apply the similar rule for the other company. And in case of other company, what is the EBIT and what's the EBIT number by using this financial leverage of 3? Financial leverage of 3. Is it 3,000? Yep. Perfect. So we can get the PBT, tax and PAT numbers. Now how do we go about the other numbers? I mean the sales, variable cost, contribution. Before that, we'll have to take help of margin of safety. Right, guys? So we can get the operating leverage is, can be simply calculated as 1 divided by margin of safety. So it is going to be 1 divided by, what is the margin of safety? 0.2. 1 divided by 0.2. So how much is the operating leverage? Can I say operating leverage is 5? Correct, guys? So operating leverage can be computed as contribution upon EBIT. Do we know the value of EBIT? Yes, sir. So for our operating leverage of 5, we get this as contribution upon EBIT of 4,000. So in the first case, what will be the amount of contribution? 20,000, right? Amount of contribution is 20,000, right? Similarly, when you use the margin of safety and operating leverage for the company B, what is the contribution? 12,000. Of course, the fixed cost is now the balancing figure, which is 20,000 minus 4,000, and here it is 9,000. Right, guys? 16,000 and fixed cost is 9,000. Now, sales less variable cost, we have the contribution and all this aspect. Now, how do we get this sales? Because we have the PV ratio of 25% and 33%. Okay, so PV ratio is 25%. So PV ratio is computed as contribution upon sales is equal to 25%. We know the contribution for first case, which is 20,000. 20,000 upon sales is 25%. Then what will be the value of sales? Value of sales will be 20,000 divided by 25%. So sales is working out to be 80,000. Right, guys? Sales is 80,000. Variable cost is simply the difference between the sales and the contribution. Same way, can you give me the value of sales for the second company? For the second company, it is 36,000. Simple, guys. So that completes question number 12. It's easy. Okay. Now look at question number 6. X Limited has estimated that for a new product, the break-even point is 20,000 units. If the item is sold for rupees 14 per unit and the variable cost is rupees 9 per unit, calculate the degree of operating leverage for sales volume of 25,000 units and 30,000 units. Okay, so break-even point is 20,000 units, guys. We have the break-even point as 20,000 units. Okay. If the item is sold for 14 per unit, so sale price per unit is 14 and variable cost per unit. Variable cost per unit is 9. Okay. Calculate the degree of operating leverage for sales volume of 25,000 and 30,000. Now, for a sales volume, or let us first compute sales volume. There are two sales volume given. One is the 25,000, another is 30,000. If sales volume is this number, what is the margin of safety? What is the margin of safety? If the break-even point is 20,000, sales volume is 25,000. Margin of safety. When I say margin of safety is 25,000 minus 20,000, and here it is 30,000 minus 20,000. Now this is of course the margin of safety, but we want margin of safety in percentage terms. So this will be 5,000 divided by the sales volume, which is 0.2 and 0.33, right? Now, do we know some relationship between margin of safety and the operating leverage? Yes. Do we know some relation between margin of safety and operating leverage? Or how do we define the operating leverage for margin of safety? Can I say it is 1 upon margin of safety? Right, so that is 1 divided by margin of safety. So here we get the operating leverage to be 5 and 3. So what was the use of this sale price and variable cost? It was of no use. Sale price and variable cost were absolutely of no use because we were calculating the leverage on the basis of connection between the margin of safety and the operating leverage. Right, guys? Yes. Simple. Simple, everyone. Okay. So with that, we are through with quite a good number of questions for leverages. So let's then do one thing. Let's take a break of 10 minutes, 10, 15 minutes. And then after that, we'll come back. I'll take up your queries, right? And then probably, look at the queries from the previous chapters also. Yes, Rinku? Yes. Okay. So, any specific question that you want to discuss? Yes, Sai Kiran.
Sir, this while doing this capital structure theory problems on arbitrage, we have done one problem, sir.
Okay.
Because it is a lengthy problem and that there are some steps. You told that same item, same model you will do on
Same model.
arbitrage.
Yeah.
One more problem, please, sir.
One more problem on arbitrage. Okay. I'll take that note.
Yes, sir. So because there are a lot of steps. Now, if you do two models, then only you can understand, sir.
Let me list down
Question 10, sir.
arbitrage one problem. Okay, that I'll do it now. Then
Capital structure, question 10, sir.
yeah.
A different question we want, sir.
Arbitrage problem one. Capital structure question 10.
Yes, sir. Yes, sir.
In my
That
handout.
was done, sir. We want different problem.
Okay, we'll take a question from module.
Please, sir.
Yeah? Okay, fine. Then chapter 8, 18.c. What is? Yes, Hardik.
Sir, sir, arbitrage was one of my problem also, and sir, question number 6 in your handout is one of the problems of arbitrage.
Question number 6 of
Yes,
capital structure, na?
yes, sir.
Okay, this is what I will do. Then
And sir, I have one doubt in cost of capital. One part.
one part
Sir,
of cost of capital.
sir, example 12, second part, and sir, example 13, second part.
Okay, fine.
And sir, in capital structure, question 5.
Question number 5 of capital structure.
Sir, sir, question 5 and question 12.
Handout.
Please. Yes, sir, handout. Yes, sir.
Okay. And Sadabali is saying chapter number 4, illustration 18. Point C, which is chapter number 4. Yes, Bhavna. Okay, cost of capital, illustration 18. Point C. Okay. Yeah, Bhavna. So just list down all the queries and then we'll get it sorted one by one.
Good evening, sir.
Yeah, good evening, Bhavna.
सर इसी चैप्टर का लिवरेज मारेगा सर क्वेश्चन नंबर 5 समझ नहीं आया क्वेश्चन नंबर 5
मेरा हैंडआउट का
प्रैक्टिकल क्वेश्चन स्टडी मैथ का सर
प्रैक्टिकल क्वेश्चन फ्रॉम स्टडी मटेरियल. ओके, ठीक है.
बस यही डाउट है.
ओके, चलो ठीक है. So let's take up one by one. Arbitrage, one more question on capital structure. Okay, so let me download, like, the module capital structure. Just open it. Mhm. One more question on arbitrage. Yes, Srini, I'm getting your messages. Okay, so let us take this particular question. Is this what we have done or no? Question from the capital structure handout. Sixth, I think this is what we have done, right? Correct? Question 10 and illustration 6 is same. Correct. So let me take then illustration 7. Right? Okay, guys.
That 6 is the same question, sir. That's what I wanted to.
Yeah. So let me take this question number 7 for understanding the arbitrage. Okay. So here we have this question. The following data is available in respect of two companies having the same business risk. So both the companies are into the same line of business. The only point of difference is their capital structure. Okay. Capital structure. So following data is available in respect of two companies. Capital employed, both cases it is 2 lakh. The unlevered company is having no debt and the levered company is having debt. Now EBIT is 30,000 and KE is 12.5%. So let us say we're looking at a levered company and unlevered company. So there we have a EBIT of 30,000, which is same for both the entities. From that, we subtract the interest. Interest will be 1 lakh into 10%, which is 10,000, and unlevered interest is 0. So can I say PBT will be 30,000 minus 10,000, which is 20,000, and this is 30,000. Okay. Then we have the cost of equity given to us to be 12.5%. Cost of equity is 12.5%. So what will be the value of equity? Value of equity, can I say it will be PBT divided by 12.5%, and here it will be divided by 12.5%, 2,40,000. Correct, guys? Then we had the value of debt. The levered company had a value of debt to be 1 lakh. Unlevered was having no debt. So what about the value of the company or value of the firm? Value of the firm will be value of equity plus value of debt, which is 2,60,000 and 2,40,000. Now, out of these two companies, which company is overvalued? Which company is overvalued? The levered is overvalued, right? Because ideally, as per both of them should be at par. In the absence of any taxation, both of them should be at par. They aren't par. So, when we talk of valuation, this is overvalued and this is undervalued. So, levered firm is overvalued, unlevered firm is undervalued, right? So, this particular thing, we have overvaluation and undervaluation of levered and unlevered aspect. Now, where will the investor shift from? The investor will shift his investments from which company to which company? Obviously, from levered to unlevered, because he will be selling those shares or the shares of those companies which are having high valuation, and he will invest in those undervaluation companies. So even the question has given us that holding 15% share. So consider the investor with 15% shareholding in. Consider the investor with 15% shareholding in levered form. Right? So investor is going to shift his investment from levered to unlevered. So step number 1. What will be the realization from sale of shares of levered firm? What will be the realization from sale of shares of the levered firm? Yeah, guys. How much are you going to realize? How much amount are you going to receive when you will sell the shares of levered firm? Because levered firm with the equity shares 1,60,000 into 15%. So what will be the realization? Can I say 24,000? You will receive 24,000. Then step number 2. Step number 2, realization from sale of shares is 24,000. What will be step number 2? Step number 2 is obviously taking this money and investing in unlevered form. But can I do the investment as it is? If I just take 24,000 from here and invest in unlevered, is the risk remaining same? No. So to match the risk, what shall I do? To match the risk, what should I do? Can I say borrow amount, borrow 15% of, or let's say borrow an amount equal to 15% of loan amount of levered. So what was the loan in levered? It was 1 lakh. So that's simply 1 lakh into 15%. So how much are we going to borrow? Right? We're going to borrow 15,000, right? Then step number 3, we're going to borrow 15,000. So what will be the third step? Step number 3 will be, what will be the third step, guys? We're going to borrow 15,000. Third step will be invest the total amount in shares of unlevered form. So what will be the amount of investment? 39,000, right? 39,000 will be the amount that I'll be investing in the shares of the unlevered firm. Correct, guys? 39,000 will be the amount that I'll be investing in the unlevered firm. Then finally, step number 4. What will be the percentage shareholding in unlevered firm? Percentage shareholding will be, can I say 39,000 invested in the total value of 2,40,000. So it is 39,000 divided by 2,40,000, which is 16.25%. 39,000 divided by 2,40,000, which is 16.25%. And then we have like step number 5. compare the earnings from investment in unlevered. So in unlevered, you have like 16.25% of profits, which is 30,000. Right. So this is 16.25% into 30,000, which is 4875. Now, of course, I cannot take this entire earnings because I need to pay the interest also. So interest that will be paid will be 15,000 into what was the rate of interest? Rate of interest is 10%. Right? So 10% of 15,000, which is 1,500. So what is the net earnings? Net earnings will be 4875 minus 1,500, which is 3375. So net earnings is 3375. Right? What was the earnings in levered entity? What was the earnings in levered entity? In the levered entity, the profit was 20,000. 20,000 into, we had 15% stake in that, which is 20,000 into 15%, which is 3,000. So what is the net gain? Net gain is 3375 minus 3,000, which is 375. So there is a gain of 375. So of course, investors are going to shift from the levered entity to unlevered entity. So that will lead to reduction in the value of the levered entity and increase in the value of the unlevered entity. And over a period of time, both of them are going to be equal. What if we won't borrow and invest only proceeds? No, you have to borrow because otherwise your risk is not matching. Your risk of investment is not going to match. So you have to borrow to match the risk. Then only you say, right? Because if you are earning more by taking more risk, then it doesn't make any sense. So I have to match the risk of my investment also. Okay. Is this clear, everyone? Okay. Fine. Then let me just do this question also. One more question for arbitrage. Conclusion remark. Conclusion remark will be the same thing, that the investors will shift from levered to unlevered, and due to which the value of levered company will go down and value of unlevered company will go up, only up to the point where both the values are equal. This is done. Question 9 is done. Yeah. I don't think I have done this. The question might be there in handout, but because this is a reverse arbitrage that is happening. Here the investor is shifting from unlevered to levered form. So we haven't done that. So let me do it over here. Levered and unlevered. Okay, so we start with EBIT. EBIT is 30,000. Unlevered is having a EBIT of 30,000. From this we subtract the interest. So interest is, of course, levered is having an interest of 10,000. Here there is no interest. Then we get the profit before tax as EBIT minus interest. Right? So levered minus EBIT minus interest, that's your PBT. Now we can get the value of equity by simply taking the cost of equity. So cost of equity given as 20% here and it is 12.5% here. So value of equity will be simply the PBT value divided by the K. And then we add the value of debt. Value of debt is 1 lakh. So value of the firm is value of equity plus value of debt. And this is 2,40,000. Now in this case, which company is having a higher valuation? Which company is having a higher valuation? Unlevered. So where will the investor shift from? An investor is going to shift from unlevered to levered company. So we'll say consider an investor with 15% stake in unlevered. So step number 1. The first step would be the levered. The investor is going to sell the shares of unlevered. Sell the shares of unlevered. This will be selling the shares of unlevered. So it will going to be 15% of 2,40,000. So what is the amount that I will receive on selling the shares of unlevered? The amount that I will get by selling the shares of unlevered, 36,000. Right? Step number 2. If I invest this 36,000 in the shares of the levered company, will the risk remain same for both cases? Yes. Right? So is risk remaining the same? No. Your investment is in unlevered was not subject to any amount of debt. But whereas whatever investment you are making in the levered form, there is an indirect debt by way of the company's debt. There is an indirect debt. Like if I invest this 36,000 in the levered form, if I invest this 36,000 in the levered form equity shares, right, I will be getting some 30 get stake, but that stake will be again subject to the risk that the company has undertaken with regards to the debt. Now, how do we tackle this? How do we tackle this particular part? How do we do away with the risk of the company's debt? How do we do away with how do we cancel the debt of the company? Like, yes, exactly. We will invest in the debentures of the company also. Right? We will be investing in the debentures of the company also. So like if you see the value of debt and equity is half and half over here. So we will say invest in debt and equity. Invest in debt and equity of levered form. Invest in debt and equity of levered form. So invest in the debt and equity of levered form in the proportion of capital structure. Now, capital structure over here, value of equity and value of debt is equal. So we can say 50% in debt and 50% in equity. If I'm going to invest 50% in debt and 50% equity, how much amount will I invest in debt and how much amount will I invest in equity of the levered company? 18,000. Right? Now, can I say my investment in equity of 18,000 is subject to some amount of debt? But you know what? We have got that same debt. So can I say I'm cancelling the risk? I'm simply cancelling the risk that is coming to the equity portion. Instead of taking money from outsider, we can simply take money or we can simply invest in the debt on ourselves. Now the step 3 would be to calculate interest or calculate income from levered firm. What will be the income from the levered firm? Obviously from equity shareholders and also from the debt. Right? From equity shareholder, can you tell me what is this 18,000 translating to? Like this 18,000 is equal to how much percentage stake in the equity? Can I say 18,000 divided by 1 lakh? So what proportion ownership are we having? 18%. So from equity shares, we will be obviously having profits 18% share. 18% share of profits. So it will be like 20,000 into 18%, which is 3,600. Right? 20,000 into 18%, which is 3,600. Then next will be 20,000. Sorry, I have invested 18,000, on which interest will be paid to us at 10%. So interest earnings is 1,800. So total earnings that we have is 5,400. What was the income earned in unlevered form? What is the income that we were earning in the unlevered form? Income that we were earning in the unlevered form. Can I say unlevered form had a profit of 30,000? In that 30,000, we were having 15% stake. 30,000 into 15% stake. So our income over there was 4,500. So what is the increase in income? Increase in income of investor. Can I say 5,400 we are earning instead of this 4,500? So that gives us an increase in income to be of 900 rupees. So will the investor shift from unlevered entity to another levered entity? Will the investor shift from an unlevered entity to levered entity? Yes, because he is having a 900 additional income. So by investing in the levered entity, we are getting a additional income of 900. So that is the extra income which we are having. And therefore, the shares of unlevered company will be sold. Shares of levered company will be purchased. Unlevered companies shares will be trading at there will be downward pressure on unlevered company. There will be upward lift in the shares of the levered company, and at over a period of time they will be at par. Okay. Why computation of debt income? Why do we do 18,000 into 10%? 10% is the rate of interest. Rate of interest is 10%, right? Being a debt, investing in debt, you won't get a share in the profit. You are going to get the interest on the purchased debt. So if you have purchased debentures worth 18,000, on that 18,000 you will get 10% as the interest. Got it? Okay.
Sir, for the same problem, if you do in the reverse from levered to unlevered whale, whether it will be minus 900,
It will be a loss of 900.
the same result will come, sir, in reverse order.
900. Loss will be 900.
Same in negative, same
Yes.
figure will come.
Yes, yes.
Okay, sir.
But why would you like to have a strategy which is resulting in loss? So you always move from a
That is okay.
lower
For
value.
calculation purpose, I am asking, sir, whether the same result will come, I am asking.
Obviously, you will always move from high value to low value.
The same result with the negative value will come.
Yeah.
Okay, okay.
Textbook, it is given as step 3, 18,000 into 20% for equity. $18,000 into 20%. $18,000. Yeah, it's just the same thing because that KE was 20% here. Okay, and anyways, 18,000 into 20%. Yeah, you're investing 18,000, right? And on that, the company is giving you 20% return. The result will be same, no change much. Okay, guys. So we are done arbitrage 2 questions. Now question number 6 of capital structure handout. Capital structure handout. Question number 6. Okay. Hypothetical Limited is in need of 1 lakh to finance its increasing net working capital requirement. The finance manager of the company believes that its various costs and share price will be unaffected by the selection of a particular plan. Since a small change is involved, since a small sum is involved, debentures will cost 10%, preference shares will be 11%, equity shares can be sold for 25 per share. Tax rate is 35%. Financing plans are given. We need to get the financial break-even point. So first we need to identify the capital structure. So we have got like 3 plans. Plan 1, plan 2. Not this, then which one? Exactly, this is a very simple question. Which one?
Sir, theory of capital structure.
Capital structure theory.
सर उसमें भी सर पॉइंट बी है, सिर्फ सेम ही है क्वेश्चन, लेकिन बस सर उन्होंने कोई परसेंटेज नहीं दिया.
Point B.
Yes sir.
Yeah, suppose value of explain the process means the investor, you just have to write that investor will switch his investment from the levered company to the unlevered company because levered company is having a higher valuation. You cannot calculate other things because percentage is not given.
अच्छा सर, मेरे को लगा कि ये प्रैक्टिकल क्वेश्चन है, मैं अज्यूम करके कर रहा था पूरा.
No.
ठीक है सर.
Okay, so that is done. Then cost of capital, example 12 part 2 and example 13 part. This is from the study material, I suppose. Let me take the capital structure handout, question 5 and 12. Again, 5 and 12, which ones? Where this capital structure theory or capital structure problems? Just taking the handout part first. Theory? 5th and 12th. Okay, 5th. Zenith is presently financed by equity shares. The current market value of 6 lakh. Dividend is 1 lakh 20 has been paid. Then this level of dividend is expected dividend to be paid indefinitely. The company is thinking of investing in a new project involving an outlay of 5 lakh now and is expected to generate a net cash receipts of 1 lakh 5,000 per annum definitely. The project will be financed by issuing 5 lakh debentures at a market rate of 18%. Ignoring tax consideration, calculate the value of equity shares and gain made by shareholders if the cost of equity rises to 21.6%. Prove the weighted average cost of capital has not been affected by gearing. Okay. So presently financed by, or let me just put up the solution for this in front of you. Now the solutions. Let me solve it because it will take time for us to. Current market value of equity. So value of equity is presently 6 lakh. 6 lakh. A dividend of, and it's fully financed by equity share. A dividend of 1,50,000, 20,000 has been paid. Okay, the dividend is 1,20,000. The level of dividend is expected to be paid indefinitely. Company is thinking of investing in new project involving an outlay of 5 lakh now, and is expected to generate a net cash receipts of 1,05,000 per annum. So the project would be financed by 5 lakh debentures at a market interest rate of 18%. There is no tax given over here, so it's everything before tax. Okay. Generate a net cash receipts of 1,05,000. Now, since the amount of dividend is paid, we will have like EBIT less interest, which will give you PBT. Then we have less tax. There is no tax. So this amount, the current market value is 6 lakh. The dividend of 1,20,000 has been paid. So we assume that under this capital structure theory, we always assume that entire amount is paid out as dividend. So whatever was that 1,20,000, that was your PBT which was paid out as dividend. Since there was no interest, can I say EBIT will be also 1,20,000. Now, when you are going for a further expansion, you are like bringing in some debt into your business. Debt of 5 lakh is purchased in, is bought into the business. Okay, debt is bought into the business. Now that debt, of course, this EBIT will be like 1,20,000 plus additional debt of 1,05,000. Additional, EBIT will be generated by 1,05,000. So additional debt, it is 2,25,000. Now interest that will be paid will be 5 lakh into 18%. 5 lakh into 18%, which is 90,000. So PBT is like 2,25,000 minus 90,000, which is 1,35,000. So PBT is 1,35,000. 2,25,000 minus 90,000 is PBT 1,35,000. Now the question is, calculate the cost of equity shares and gain made by the shareholders if the cost of equity rises to 21.6%. So now, earlier KE was simply PBT divided by value of equity. Now they have given that KE is 0.216. So we can say value of equity was 6 lakh, whereas this value is 6,25,000. So value of equity is 6,25,000. Okay. Then value of debt, here it is 0, and here we have like 5 lakh. So what is the value of the firm? Value of the firm will be 6 lakh plus value of debt. This comes out to be the value of the firm. Calculate the value of the equity shares that is done, and gain made by shareholders. What is a gain made by shareholders? Can I say the value became 6,25,000 from 6 lakh? So gain for shareholders is 25,000. Right? So gain from the shareholders is 25,000. Correct, guys? Yes. Gain is 25,000. Prove that the weighted average cost of capital has not been affected by gearing. Now, weighted average cost of capital, KO. How is KO computed? EBIT upon value of the firm. So, EBIT upon value of the firm, it is 20%, and here again it is same 20%, which is EBIT upon value of the firm. So, weighted average cost of capital has not changed.
Sir, in this question, we will always assume that the amount which is, sir, it is a part of theory that
Yes,
the
it is
amount
an assumption. It is an assumption of the theory that whatever is earned by the company that will be paid out as dividends.
Okay, sir.
Because
Sir,
otherwise,
this was the only part.
if you're retaining it, then can I say investors will start getting a higher rate of return because you'll be reinvesting and earning greater, obtaining a growth in the dividends. So that is
Sir,
what we are not assuming.
sir, in none of the capital structure theories, we assume that we will have a retainer.
No, we don't assume a retainer. Yes.
Okay, sir. Thank you, sir.
Okay, so 5 and 12. Again over here, question 12 is same as what we have done. 12 is similar to what we have done in the previous questions.
Sir, in this question number 12, equity capitalization rate is given for B.
Yeah.
And sir, again, they are asking for the equity capitalization rate.
Equity capitalization you have to compute for A.
Compute for A only.
A, yes, because they are saying approach, right? The approach means value of levered equal to value of unlevered plus debt into tax rate.
Yes, sir.
Right, so that method we have to use to get over here. Okay, I will share this solution with you.
Okay.
Okay.
Okay, sir. Sir, one small doubt in this handout only. In sir, question number 11. Sir, question number 11. Is it also a theory question?
No, you have to assume over here. You can take the value of some money limited to be maybe 900 or 9,000, and then 300 of that will be value of loan, and then carry out the other process similar.
Sir, arbitrage as usual, which we do.
No, there is no arbitrage. But we have to compute the cost of equity.
Okay, sir. So we have to assume the values.
Yeah, you have to assume the total value in multiples of 3 lena, so that it becomes easier for you to make it 1/3.
Okay, sir. Okay, sir.
Okay, then cost of capital, practical, cost of capital example 12. So let me open the module, cost of capital. Cost of capital example 12 part 2. Example 12. This is example 12 part 2, example 13 part 3. This is handout, cost of capital handout. Okay. Example 12. It is expected that AB company will earn about 10% on book equity and shall retain 60% of it. This 10% on book equity means this is return on equity. And this is B. So this will be used to calculate the growth rate. G equal to B into R. Tha na? We had the G is equal to B into R. So B is basically 60% and R is 10%. Yeah.
Sir, ये Gordon's model से होगा ना?
Yes, Gordon model.
और सर ग्रोथ ऑफ परपेचुइटी मतलब सीधा डिविडेंड 3.36 डिवाइड बाय 7.5.
हाँ
ठीक है सर. और ये सर एक्सपेक्टेड है तो ये इसका मतलब D1 हुआ ना?
D1 होगा. यस परफेक्ट
सर. उसके बाद सर 13 part 2 है.
Your project is expected to give a return of 10% return under which condition? पहले आप क्या करोगे इन सबका ना वेटेड एवरेज कॉस्ट ऑफ
ये सर कर निकाल लिया मैंने. ये पूरा निकाल लिया सर. वेटेड एवरेज कॉस्ट ऑफ कैपिटल ये सबका निकाल दिया. लेकिन
वेटेड एवरेज कॉस्ट ऑफ कैपिटल निकाल लिया.
हाँ जी सर.
If there is a project which is likely to give you 10% return, right? तो obviously project आपको 10% रिटर्न दे रहा है तो आप अपना कॉस्ट कितना रखने का कोशिश करोगे? 10 के नीचे.
यस सर.
राइट. तो इनमें से जो भी ऑप्शन में 10 के नीचे वेटेड एवरेज कॉस्ट ऑफ कैपिटल होगा, दैट शुड बी द कंसिडर्ड ऑप्शन. दैट प्रोजेक्ट कॉस्ट शुड बी मे बी अप टू 2 lakhs और मे बी अप टू 5 lakhs और 10 lakhs, जो भी आंसर होगा.
सर मैं आपको बता देता हूँ सर, प्रोजेक्ट एक्स का सर 12.487 है कॉस्ट ऑफ. सर मैंने जैसे निकाला प्रोजेक्ट एक्स का कॉस्ट ऑफ इक्विटी 12.487 हुआ.
487 कहाँ से आया?
सर क्योंकि कॉस्ट ऑफ कैपिटल ऑफ 2 प्रोजेक्ट्स दिया हुआ ना, मतलब 6,50,000.
6.5 lakhs के लिए यू विल हैव टू टेक दिस कॉम्बिनेशन. डेट इक्विटी रेशियो दिया है ना 40 और 60, तो ये 40% मतलब 0.4 into 12% प्लस 0.6 into 14%.
सर ये उस पे नहीं होगा स्लैब रेट पे कि सर जैसे
दिस इज अ कॉस्ट ऑफ प्रोजेक्ट, दिस इज नॉट द कॉस्ट ऑफ डेट. ये ओवरऑल प्रोजेक्ट का कॉस्ट है भाई, दिस इज नॉट द अमाउंट ऑफ लोन.
सर एक बार ट्यूशन दिखा दो फिर अगर है तो. सर समझ नहीं आया, मैंने सर इसको स्लैब रेट समझ के करा.
ना, इट इज प्रोजेक्ट कॉस्ट. तो लाइक इफ यू आर मेकिंग इन्वेस्टमेंट अप टू 2 lakhs, कॉस्ट ऑफ डेट विल बी 10 and 12. अगर आप इन्वेस्टमेंट 2 से 5 लाख के बीच का कोई प्रोजेक्ट उठाते हो तो आपको डेट पड़ेगा 11% पे और इक्विटी आएगा 13% पे.
तो सर 6.5 का इसका मतलब हुआ कि मेरा डेट का कॉस्ट होगा 12% और कॉस्ट
इक्विटी होगा 14%. यस.
और सर 14 लाख का मतलब हुआ 13% और 14.5.
यस, परफेक्ट.
और फिर सर कॉस्ट ऑफ मतलब केओ निकाल दूंगा मैं.
हाँ.
और उसके बाद फिर सर आफ्टर रिटर्न 6.5 का मतलब 6.5 into 10% और 14 लाख का 10%.
नहीं, वो करना ही नहीं है, ये अलग पार्ट है. दिस इज ऑल टुगेदर. यू विल हैव टू फर्स्ट कंप्यूट वेटेड एवरेज कॉस्ट ऑफ कैपिटल इन ईच ऑफ दीस सिनेरियोस.
यस सर.
चारों केस में निकालना है. पहले तो इसको आफ्टर टैक्स कॉस्ट ऑफ डेट पे लेके जाओगे.
हाँ जी सर.
देन यू विल कैलकुलेट द वेटेड एवरेज which will be like 0.4 into 10% plus 0.6 into 12% for first alternative. सेकंड के लिए 10% into सॉरी जो भी नंबर रहेगा ये वेटेड एवरेज ये आफ्टर टैक्स into 0.4 और 13 into 0.6. So this way you will get 4 different weighted average cost of capital. अब आपको देखना है कि ये चारों में से कहाँ पे आपका वेटेड एवरेज कॉस्ट ऑफ कैपिटल 10% से कम है.
अच्छा सर, ठीक है, समझ गया, आप समझ गए.
ओके,
थैंक यू सर.
ओके, कॉस्ट ऑफ कैपिटल हो गया. Then cost of capital illustration 18.C. Illustration 18.C. Illustration 18. Yeah. Determine the amount that can be spent for capital investment before new ordinary shares must be sold, assuming that retained earnings for the next year's investment is 50% of 2022. Okay. जैसे कि लग रहा है we have solved this maybe in our revision session. ये solve किया था क्या? है ना? We have solved this in our revisionary session. Yes. Full question we have solved in the revisionary session, so you can refer that session. I think we had it on last Tuesday. Just अभी जो Tuesday गया, in that session we had discussed this entire question in detail. And just refer that part. Pretty simple. You have to just take whatever is the amount of retained earnings, you take it in that proportion. You can refer that lecture of revisionary session, guys.
Sir, for direct tax and indirect taxes, there will be change of syllabus every year, not due to change in Finance Act and change in taxes. So in financial management, there is no such issue, no, sir?
There may be changes in the syllabus, like new questions or new concepts may be added. So you need to keep checking the institute website for the new modules.
So I'm having June 2024 reprint. I'm having, sir. Whether from that also changes may be there, sir.
June 2024
reprint I had, sir.
Okay, please recheck the module because we have right now the prints from up to for May 2025 module.
So, but the syllabus may change, sir. Syllabus may be changed.
Syllabus may not change overall, but there may be some small changes also. We need to keep a track of the module, like whatever module is applicable for your attempt, you need to refer that.
That how to identify, sir. That how to identify.
go to the institute website. You go to the institute website and see each of the chapters are, the topics are allotted over here. Like see, you can see the financial management and strategic management applicable for May 2025.
Okay. So that is added, sir. That point is added.
Sorry.
Okay, sir.
Okay.
We have to check from BYS portal.
Yeah,
Okay.
look at the BS portal. Maybe you can get some new questions from there also. Some new variety of questions.
But overall syllabus may be same, na, sir. Identical.
Yeah. Overall it will be same.
There will not be much change. Na? Only problems will be additional.
Additional problems may be there. Some additional concept may be there. You need to keep a track of it.
Okay, sir.
सर एक छोटा सा क्वेश्चन और था सर, अगर रेशियो एनालिसिस में हमसे पीएनएल बनवाते हैं तो सर इनकम स्टेटमेंट ही बनाए ना?
हाँ, इनकम स्टेटमेंट बना लो।
और सर दूसरा ये था कि अगर सर बाय चांस हमको क्वेश्चन में जैसे केडी निकालना है और सर क्वेश्चन में हमको सेल वैल्यू भी दी हुई है और मार्केट वैल्यू भी दी हुई है, तो सर हम मार्केट वैल्यू हमको सेल वैल्यू नहीं दी हुई, हमको मार्केट वैल्यू दी हुई है।
मार्केट वैल्यू लेना है,
मार्केट वैल्यू लेंगे ना, और उसमें से उसी में से फ्लोटेशन कॉस्ट माइनस कर देंगे।
जी यस। यस किरण।
गुड इवनिंग सर।
गुड इवनिंग किरण।
लेवरेज का एक्सरसाइज 11 में डाउट है, समझ नहीं आ रहा हाउ टू प्रोसीड अबाउट इट।
मेरा हैंडआउट का
लेवरेज का एक्सरसाइज एग्जांपल 11।
ये this is not right now right time to solve it. This you will be able to solve after cost of capital, after the chapter of cost. Sorry, yeah, we have done with cost of capital, right? हाँ, तो फिर we can solve it. Yeah. So like change in revenue and change in operating income दिया है, and we have the beta values. We can calculate the operating leverage. Yes. Can we calculate the operating leverage? Because operating leverage is what? Percentage change in EBIT upon
percent change in
revenue. Or
yes.
Sales. So we already have this like 25% upon 27%, 32% upon 25%.
Yes,
Tell me what are the numbers?
Sir, so what beta has to do with it?
I'm telling you, wait. So
Okay.
25 divided by 27, this is 0.92. Then 32 divided by 25, which is 1.28. So 36 divided by 23, it's 1.56. Then 40 divided by 21, it is 1.9. Okay. So now for all the four companies, do you see any peculiar trend between operating leverage and the beta values? Yeah. If your beta is increasing, can I see your operating leverage is also in an increasing trend, or I can see the company which has a higher operating leverage, it also has higher beta, right? So that is the comment that we have to write it, that the companies which are having higher operating leverage are also having a higher level of betas. Okay, fine. So with that, let's just put it end to our session. We will be definitely meeting for some more revisionary sessions. So if you have any more queries, you can come up with in our revisionary sessions. We have the revision lectures on every Tuesday. So you can come to me in that session so that we can discuss that further. Okay.
सर लिवरेज का क्वेश्चन नंबर 5 स्टडी मैट का और बता दीजिए।
स्टडी मैट का लिवरेज का क्वेश्चन नंबर 5। क्वेश्चन नंबर 5। प्रैक्टिकल प्रॉब्लम।
प्रैक्टिकल क्वेश्चन सर।
प्रैक्टिकल क्वेश्चन 5। Sales revenue of TMS is 20 per unit is 20 lakhs, contribution 10 lakh. At present level of output, degree of operating leverage of company is 2.5. The company does not have any preferential. The number of degrees on like applicable corporate income tax is 50%, rate of interest on debt capital is 16%. Calculate EPS at sales revenue and amount of debt capital. If 20% decline in sales will wipe out the EPS. Now this is simple. Agar aapka there is a 25% change in EPS. Percentage change in EPS कितना है 25%. उसकी वजह से आपका EPS हो जाएगा. Percentage change in sales है आपका 25%. उसकी वजह से EPS 0 हो जाएगा. So EPS अगर 0 हो रहा है means what is the change in EPS? Can I say 100%? है ना? 100% हो गया ना change?
Yes, sir.
हाँ. तो अगर 25% decline in sales की वजह से 100% EPS decline हो रहा है, तो what is the combined leverage? 4 हो गया, क्योंकि 100% change in EPS upon change in sales, 100% upon 25%, so 4 हो गया आपका operating leverage.
Yes, sir.
तो बस ये का sorry not bad, my bad, operating leverage नहीं, combined leverage, because sales से हम लोग EPS connect कर रहे हैं, right? We're connecting with sales with EPS. This is there with it. So, percentage change in EPS is 100%. Percentage change in sales is 25%. So, what is the degree of combined leverage? Change in EPS upon change in sales. तो ये आ जाता 4.
Yes, sir.
तो ये 4 आ गया. Now what we have to compute? Calculate the EPS. तो अभी आपका degree of combined leverage is 4. Degree of operating leverage है 2.5. You can get the financial leverage simply by dividing 4 with 2.5, because combined leverage is operating leverage into financial leverage. Now you have all the leverage numbers. आप income statement बना सकते हो जैसे normally करते हैं. ठीक है?
Okay, sir.
Okay, चलो, let's stop here, guys. See you soon. Bye bye.